In March 2023, a bank run happened at the speed of smartphones and social networks. You watched a century, old financial panic compressed into hours, not days, and felt the surreal speed of money moving on tiny glass screens. This opening image is not a metaphor, it is literal, and it rewrites what you assumed banks were built to withstand. You are about to follow a fast human and technical chain reaction that led to the second largest bank failure in United States history. What happened next will shock you and force questions about the safety of money you thought was slow and certain. Silicon Valley Bank began in 1983 with a simple mission to serve the emerging technology community. Over 4 decades, it became intimate with startups, venture capitalists, and entrepreneurial dreams, and built a reputation as the Bank of Silicon Valley for founders and fund managers. By early 2023, the bank had grown to roughly $212 billion in assets and ranked as the 16th largest bank in the United States. That scale made SVB powerful and exposed it to a concentrated customer base that lived and breathed technology and venture funding. The bank's corporate culture and product design reflected startup rhythms rather than traditional broad retail banking practices, and that focus would become a crucial vulnerability. SVB's clientele was unusually concentrated, with large deposits coming mainly from venture-backed startups and technology firms. Many corporate accounts held deposits far above federal insurance limits, and those uninsured balances represented a large share of total deposits at the bank. You need to understand that concentration, when many customers are similar and connected, their reactions become correlated and amplify risk in ways retail banking usually avoids. Concentration meant SVB's deposit base was fragile because startups share the same financing cycles and the same advisors. And those advisors influence coordinated actions. The bank's moat became a single limb instead of a wide foundation. And that single limb would not hold under shared panic. Like many banks, SVB invested customer deposits in bonds and longer, dated securities to earn a spread on interest rates. That decision is normal for banks because yield from securities funds lending and services, and it appears conservative until interest rates change sharply. When the Federal Reserve began aggressively raising rates in 2022 and 2023, the market value of those long-duration bonds fell, creating unrealized losses on SVB's balance sheet. Those losses were largely invisible to customers until the bank disclosed them. But internally, they created a dangerous mismatch between liquid deposits and illiquid securities. The balance sheet had duration risk baked into it, and the rising rate environment was the slow moving trigger that would become sudden under panic. On the 8th of March 2023, Silicon Valley Bank shocked the market when it announced an approximately $2 billion loss and plans to raise fresh capital to shore up its balance sheet. That disclosure was the public equivalent of exposing a wound in a body that had hidden bruises. And it immediately escalated anxiety among its concentrated customer base. Investors read the filing, and venture capitalists and customers started to ask hard questions about liquidity and safety. SVB's announcement carried more than numbers. It carried narrative about solvency and urgency. And executives scrambled to explain their position while markets digested the news. What happened next will shock you and marks the moment where cautious concern flipped into collective panic. As the news spread, venture capital firms began messaging their portfolio companies to take urgent action and move deposits to safer places. Conversations on Slack, private group chats, and emails accelerated the flow of instructions that told startups to withdraw funds and secure payroll accounts immediately. Those messages looked like prudence to founders, but they also created a coordinated exodus when many companies acted simultaneously. But here is where it gets interesting, because the social networks that amplify ideas also amplify fear and coordinated behavior. The bank's customer base was not isolated individuals, but a closely connected ecosystem where a single memo could trigger thousands of linked withdrawals. Between the 9th of March and the 10th of March, an astonishing $42 billion in deposits left SVB in approximately 24 hours, setting a record for the fastest bank run in modern history. That number is not abstract, it represents payroll accounts, venture capital treasury accounts, and company reserves necessary to operate. Mobile banking made transfers instantaneous and real. Time rails allowed cash to exit faster than any historical precedents of lines at windows and telegrams. You should imagine the mechanical terror of watching account balances drain from your phone and knowing that those balances fund payrolls and bills. The speed of money movement created a positive feedback loop. Withdrawals became news. News triggered more withdrawals, and the cycle accelerated toward collapse. On the ground, startup CFOs and founders faced impossible choices about payroll and vendor payments with minutes to decide rather than days. You can feel the human toll when tight cash cycles meet sudden illiquidity, and entire companies made emergency plans to move payroll to other institutions. The founders who had cut their teeth on product market fit now navigated a raw financial panic that offered no easy technical solution. This was not abstract systemic risk in a distant market. It was people and paychecks and the livelihoods of engineers and designers who relied on quick access to bank accounts. The social psychology of fear compounded technical risk, and the result was literal survival decisions executed on devices in the palms of anxious teams. Inside SVB, there were frantic attempts to calm the market and find liquidity while the bank set technology teams and executives communicated with regulators. The bank tried to manage optics and reassure clients, but the combination of visible withdrawals and bond losses eroded confidence faster than any message could repair it. Executives hoped that capital raising and regulatory conversations would buy time, but time had already been compressed by digital transfers. What happened next was inevitable given the speed of outflows and the remarks in public filings, and by the early hours of the 10th of March the bank could not stave off seizure. The build-up of pressure from concentrated, connected customers became a force that traditional bank defenses could not absorb. On the 10th of March, 2023, regulators intervened, and the Federal Deposit Insurance Corporation took control of Silicon Valley Bank, shocking an industry that had largely expected slower motion. The seizure was swift, and regulators then announced measures to guarantee deposits to prevent broader financial instability and stop contagion from spreading. That guarantee extended beyond the $250,000 federal insurance limit and covered deposits that were uninsured. A move that surprised many observers. You are left asking whether the government acted to prevent panic or whether the action engineered a moral hazard for future failures. And the debate about precedent and legality continues. The immediate goal was to stabilize the system, but the decision raised profound questions about fairness and who gets protected when markets unravel. The collapse of SVB did not occur in isolation. It came within a weekend that also saw the failure of Signature Bank and increased pressure on international institutions like Credit Suisse. Signature Bank failed the same weekend, and that failure amplified fears about niche banks with concentrated clients and similar business models. Credit Suisse's challenges then accelerated into a separate crisis, showing how quickly confidence can transmit across borders and business models. Contagion is not metaphoric here. It travels through information channels, counterparties, and the psychology of investors who reevaluate risk when one institution falls. The SVB episode demonstrated how a localized panic can trigger reassessments at global institutions, because perceptions and exposures are interconnected in modern finance. Social media and instant messaging systems played a decisive role in accelerating fear and coordinating responses among venture ecosystems and corporate treasuries. Private channels moved faster than traditional reporting, and memos from venture capital firms effectively functioned as instructions that could produce mass withdrawals within hours. The viral nature of modern communication created herd behavior that banking models were not designed to survive. You must appreciate that technology both enabled SVB's growth and enabled its demise. The same networks that fueled startup funding also transmitted panic with unprecedented speed. That dual role creates a paradox for modern finance: convenience and connectivity increase both efficiency and fragility. Beyond technology, the crisis exposed structural weaknesses in banking models reliant on concentrated, uninsured deposits and large holdings of long-duration securities. Those structural weaknesses were known to economists and regulators, but they were not treated as urgent by many until failure occurred. You can draw a line from balance sheet duration mismatches to sudden liquidity crises, especially when downside scenarios are not stress, tested against instantaneous digital withdrawals. The lesson is stark. Diversification of deposits and active management of interest rate risk are not academic points. They are operational imperatives for any bank seeking resilience in a high-rate environment. When those imperatives are neglected, the consequences are fast and unforgiving. Regulatory context matters because rules shape incentives and resilience, and the SVB collapse forced renewed scrutiny of regulatory rollbacks and stress testing regimes. Some critics pointed to regulatory changes in previous years that reduced oversight for mid-sized banks, arguing that such changes allowed vulnerabilities to grow unnoticed. Regardless of regulatory philosophy, the crisis revealed gaps between theoretical safeguards and the realities of an interconnected digital banking world. You should consider whether existing frameworks adequately account for modern communication speeds and the behavioral responses they trigger, because laws written for slower eras may not prevent bank runs that unfold in hours. The policy debate that followed was as much about technology as it was about capital ratios. The human cost of SVB's failure was immediate and tangible, especially for startups that depended on timely payroll and vendor payments to keep operations afloat. Engineers, product managers, and support teams faced uncertainty about paychecks and benefits, and many founders scrambled to move funds to alternative banks or emergency credit lines. That human element reframes financial failure as an event that disrupts livelihoods rather than an abstract line item on a balance sheet. You have to look past the headlines to see the real ripple effects. delayed payrolls, paused hires, and startups that might never recover their momentum. Financial shockwaves become personal crises for people whose careers and families depend on predictable banking services. Comparing this episode to historical bank runs is illuminating because it shows how technology compresses the timeline from rumor to action in ways that antiquated assumptions do not account for. Classic bank runs involved physical lines and slow communications, which allowed time for calmer, stabilizing interventions. What you saw in March 2023 replaces queuing lines with instant transfers, and it replaces days of rumor with hours of certainty as balances drain. The result is a new class of systemic vulnerability that requires different defenses, including faster regulatory responses and new liquidity backstops designed for an era of instantaneous financial mobility. Historical analogies still matter, but the mechanisms of panic have changed fundamentally. Policy responses in the aftermath raise difficult questions about moral hazard because guaranteeing uninsured deposits may encourage risky behavior in the future. Regulators argued the decision was necessary to prevent broader systemic collapse and preserve confidence in the banking system. And many economists accepted that logic is pragmatic crisis management. Yet you cannot ignore that when the safety net expands in crisis, incentives for risk taking can change in ways that are hard to reverse. The debate now centers on designing contingencies that protect ordinary depositors without subsidizing reckless business models, and on creating transparent frameworks that limit the need for emergency guarantees in the first place. That kind of balancing requires clear rules and credible enforcement to restore trust sustainably. For banks and startups, practical lessons emerged very quickly and will shape behavior for years to come, including the need to diversify banking relationships and maintain liquid reserves for payroll contingencies. Startups learn that convenience banking with a single industry-focused provider can be risky when that provider shares the same cyclical exposures. Banks learn that product and culture must be paired with robust risk management that anticipates the speed of modern transfers. You will likely see more companies opening multiple operating accounts, staggering payroll flows, and demanding clearer contingency planning from their banks. Those operational changes are modest individually, but collectively, they will alter the structure of startup banking and reduce the concentration risk that contributed to the crisis. The SVB collapse also has wider implications for the global financial system, because investors now price in the possibility of rapid deposit flight and contagion across borders. Banks with concentrated client bases or large unrealized losses on their bond books will face increased scrutiny and potentially higher funding costs. Markets adjust quickly when trust is shaken, and that readjustment can lead to tighter credit conditions for innovation sectors that depend on banking relationships. You should watch for tighter lending standards, changes in deposit insurance discussions, and an increased emphasis on liquidity stress testing that simulates instantaneous digital outflows. The era of slow-moving banking crises has ended, and global finance must adapt to a new tempo of risk. There is a philosophical twist in all of this. The technologies that democratize finance also accelerate fragility, and your access to instant transfer is a double-edged sword. Mobile banking felt like empowerment until it became a conduit for collective panic. And the same networks that scale innovation can scale anxiety. You must wrestle with the fact that progress in one dimension can create novel vulnerabilities in another. That paradox will define regulatory and business debates for the next decade, as societies decide how to balance speed, convenience, and systemic safety in a hyperconnected world. The choices made now will determine whether future collapses are contained or amplified. If there is one clear takeaway, it is that bank runs are no longer limited by geography or operating hours, because modern rails and social networks compress reaction times dramatically. Companies, regulators, and banks must treat instantaneous withdrawal risk as an everyday operational threat rather than a theoretical tail event. Preparing for that reality will require new tools, faster coordination, and clearer rules for emergency liquidity provision. What happened in 48 hours at Silicon Valley Bank should be a wake. Upcall that the financial architecture must evolve to match the speed of modern communication. Ignoring that lesson invites a repeat of the very panic we just saw. The final image is both sobering and oddly hopeful, because crises force adaptation and innovation in policy and risk management. You can imagine better stress tests, real-time regulatory monitoring, and contingency frameworks that make emergency guarantees less likely and less politically fraught. The challenge will be to design systems that protect ordinary people without rewarding reckless banking behavior, and that balance will require judgment and transparency. If this story changed how you think about your own money, your startup, or the banking system, then that change in perspective is the important outcome of this investigation. The SVB collapse was not an isolated tragedy. It was a signal that the modern age requires modern defenses. So where do we go from here, and what should you remember about SVB and the 48-hour bank run that shocked 2023? First, the era of instant financial panic is real, and it requires operational responses from companies and policy responses from governments. Second, concentrated deposits and interest rate sensitivity are not abstract accounting problems. They are live vulnerabilities that can disrupt paychecks and businesses when conditions change. If you take one personal step after watching this video, consider diversifying banking relationships and demanding stronger contingency plans for payroll and cash management. That simple operational change can protect your team and reduce the chance that your company becomes part of the next viral run story. The modern bank run at smartphone speed is a story about technology, psychology, and institutions failing to adapt fast enough. You watched a chain reaction that was part human panic, part smooth digital plumbing, and part regulatory scramble, and you saw how quickly confidence can evaporate. The SVB episode will be studied for years as a case study in how connectivity transforms systemic risk. If this gave you a new perspective on banking, regulation, or the fragility of financial systems, please subscribe for more deep investigations into the forces shaping our world. If this gave you a new perspective, hit subscribe.